Welcome to Cup of Joe. I'm Mike Carrazzo, content manager here at Ryerson, and I'm very excited because it's a very special episode. As you're going to see later in the hour, we're going to bring on a vertical market manager discussion. But first, as always, always a special guest in my eyes, Nick Webb. Nick, how you doing?
Mike, I'm doing great. How are you?
Doing well. So a lot going on here in the market, and we've got a jam-packed hour, as I mentioned. So want to get right into it. But as always, before you kick off, what I'm going to say is I got a little Q&A button there at the bottom. If you want to ask a question, please fill it in there, and we will try to answer those as best we can for both Nick and our panel of guests later. So without further ado, Nick, take us away.
Awesome. And to everyone on the call, for those who are in America, happy belated 4th of July. Hopefully everybody still has all their digits. I saw an exorbitant amount of videos this year of people having firework accidents. So hopefully everyone had a safe 4th. Got a lot to talk about here today. And then as Mike had mentioned, on the back end of this discussion, we'll have the roundtable, which will be a ton of fun and I think a lot of really good information. But with that said, let's first run through the safe harbor provision. As we always discuss, this is not investment advice. Please do your own research. We're providing you with the best content we think we can come up with at any point in time. But we're not giving investment advice or anything like that in our slides that are coming up. So with that said, let's hop into the macro side of things. There were a couple things I said last month, one of which I think is looking like it might be spot on, one of which I got a little wrong or perhaps was a little premature on. The one that I think I may be right on, which unfortunately is a little bit of bad news. We'll start off with some bad news and then kind of head into the good news. The bad news is, as we mentioned, the idea of a recession or the concept of a recession is 2 consecutive quarters of negative GDP growth. So that's a negative GDP print, 2 consecutive quarters. We now have the official GDP print for Q1, which it's funny that it takes so long to come out, but last month we found out that Q1 GDP was negative 1.6%. What we don't know yet is what's Q2 going to look like. As we take a step back and look at some of the risk factors in the market, for all intents and purposes, I would say Q2 has certainly been a lot more difficult than Q1. That's just kind of a surface level feel aspect to it. But the good news is the Atlanta Federal Reserve actually puts together this data point, which is called the GDP Now Index. And what they're attempting to do is kind of give a live look or a fresh look into taking all of the economic data points that are presently available, throwing that into their basket, and spitting out basically a forecast for where Q2 GDP is going to land. The unfortunate news is, as we sit here right now, their model is predicting a GDP print of about negative 1.9%, so even a little softer than Q1. So as we think about the 4-letter word, which is recession, if this pans out over the next 20, 30 days as we approach the official GDP ruling, we would technically be in recession. Now, I'm not here to say, that's officially what's going to happen, but given the data points we know right now, it does look as though Q1 and Q2 combined leave us in recessionary territory. Now, I will be the first one to admit that doesn't necessarily have to mean sky is falling. It's really just a technical rules-based system that says GDP went negative 2 quarters in a row. It doesn't have to mean that metals prices are going to collapse or that housing markets are going to collapse, but general softness certainly seems like it may be coming for at least the western part of the world. Now, with that being said, the other big thing we have to look at is inflation. As we think about what the Federal Reserve is doing right now, we're seeing some pretty rapid interest rate hikes, and that's really all in an attempt to cool down this chart right here, which is CPI, the Consumer Price Index, and then the blue line is going to be your core CPI. Now, in my personal opinion, I think economists are very good marketing experts because I think it's kind of funny how they call core CPI the inflation indicators excluding energy and food, as if there are people who can really live on it, without energy and food. But that being said, core inflation, the reason why we're talking about it today is in the last Federal Reserve meeting, Jay Powell indicated that he actually likes to look more closely at the core CPI when making rate-related decisions. One of the reasons is because it tends to be less volatile. As we can see here, it also happens to be at a much lower level because it excludes things like energy and food, which are still very elevated. The reason why I think that's of note is because there is a chance that if we take the previous slide into context, if in fact we are in recessionary territory already, then it would be a pretty unique situation to have a central bank hiking interest rates rapidly in the face of a recessionary condition. The two kind of counteract one another or contradict one another. But that being said, as we look at the core CPI, so the blue line here, you can see actually in the last couple data points, it actually has moved down. So if the Federal Reserve is in fact watching core CPI rather than the headline CPI, there's a chance they actually take their foot off the gas a little bit on these rate hikes. Because one of the other things that Jay Powell did admit in the last discussion that he had about 2-3 weeks ago was that he really doesn't have the tools to impact all levels of inflation, and that being the supply side of the equation. Really, the Federal Reserve can only impact the demand side. And unfortunately, some of these situations that we're seeing, particularly in crude oil, natural gas, electricity, those are more supply side elements. And he's basically admitting that he doesn't really have the means to handle those aspects. So I think it'll be interesting to see how that evolves over, the last couple of months of summer, whether or not they do in fact acknowledge that, hey, the US economy is actually slowing a bit. Maybe we do want to take our foot off the gas on rate hikes a little.
Nick, I don't mean to interrupt you there, but I'm glad you brought that up because we've been talking about this for a while. And so, as you've said, a recession is 2 consecutive quarters of negative GDP growth. And of course, the first quarter ended a while ago, but we just got the official number, right? So negative 1.6. So when should we be looking for the official number in the second quarter, I guess?
Yeah. So I mean, it's a little frustrating because there are revisions to the GDP prints, and there are actually 3. So it happens on a monthly consecutive basis. So the first read that we're going to get from the headline GDP number is going to be, I want to say it's July 27th. So it'll be coming at the end of this month. But as we discussed, that number is going to change, or probably will change in August, late August, and then the final ruling will be September. So yeah, there could be some slight deviations. In the case of Q1, each month it moved about 0.1%. So they aren't massive moves. So, if we see the first GDP print come in at negative 1.5 or 2%, I wouldn't expect it to flip all the way to positive and then take us out of that territory. But it could move, small bits of a percentage.
It'll at least give us an indication what to expect once the official number does come out, right?
Absolutely. So we're just trying to give as early of a look as possible, which is the same thing that the Atlanta Fed GDP Now Index does. It's trying to give as early of a look as possible, but it's not set in stone. So I think if there's going to be any kind of theme to this discussion today, it's really going to be this one, which is the Western part of the world appears to be slowing down in terms of growth. It's still growth, but it's slowing growth. And you can see that pretty clearly as you look from left to right. Again, continuing as we go basically April, May to June, the colors of green are getting lighter, and that's indicative of slowing growth. Now, again, if we think we're in a recession, it's certainly not a sky is falling type situation as we're seeing it today. We're still seeing marginal growth in most parts of the Eurozone and in North America. One key thing I want to point out here is, while the Western part of the world appears to be experiencing slower growth, China, which is about 4 down here in this list, actually looks like it might be coming out of the worst bits of the last several months. Now, some of that's going to be due to the fact that it does appear as though many of their cities are reopening. We'll talk about a couple other aspects more specifically here in a sec, but there could be a scenario whereby there's really just a handing off of the torch within the economy, the global economy, of Europe slowing a little bit, US is slowing a little bit. It's not cataclysmic or anything, but meanwhile, China may be, picking up where we left off essentially. And I think visually, this chart really kind of hones into that discussion point. This is just looking at the exact same data, just in linear or graphical form. And you can see it pretty visually, basically since January 2022, while the United States has come down a little bit, it's still above 50, so it is growth. softening growth. However, you can see that since January, China has actually moved higher with regards to its purchasing managers index on the manufacturing side. So visually, I think this tells a pretty interesting story. I think this is probably the biggest thing that I'm watching at the moment, is to what force or to what extent does China, reinvigorate its economy as they come out of its latest round of zero COVID policy. Because as we've talked about in prior podcasts, China is of the size and is of the commodity influence that single-handedly they can really influence commodity markets, because they're making up 50 to 60% of most production and consumption of commodities worldwide. I will have to make one quick disclaimer. I am dog sitting for a friend of mine, and the two of them are playing a little harder than normal at the moment. So I apologize if we get a little back. What's that?
They're a little bullish right now.
Exactly. All this talk about China's got them riled up. So this is just another way to look at the same data, but it tells a similar story, which is the credit impulse data, which we've talked about this in prior podcasts. You can see it tends to be big money into their economy, big money out of the economy as they try and cool it. We are currently experiencing what looks like the beginning phase of reaccommodation to their economy. So I think that syncs up with the PMI data we've been looking at. I think that syncs up with a lot of the anecdotal data we see with regards to zero COVID policy and the removal of those lockdowns. And then lastly, this is extremely fresh data, hot off the presses this morning. China is basically in discussions to bring forward some of their 2023 budget into 2022. And it's a pretty big number. It's a $220 billion that they're contemplating putting into their economy via stimulus for infrastructure. So just on this news this morning, again, one day doesn't make a trend, but just this morning, copper prices were up by 5%, aluminum prices were up by 3%, natural gas, I think, was up 15% today, crude oil was up about 4%. So that's kind of my point, where if China is coming back to the market in a big way, and if they're going to stimulate their economy to try and really jumpstart the engine, we could see some support across the commodity complex. Now, this is the part that I kind of got wrong last month, where I said it felt like China was reopening its economy. I think I was just a little premature on it. They've kind of been going in fits and starts. They continue to have little outbreaks. It's a little unclear on how, or at least it has been up to this point, a little unclear on how quickly they want to get back to normalcy. I still, base case in my mind, still think that is what's going to occur in the coming weeks and months. Because I just don't think you can stay in that scenario for too long as a society. And the other aspect is, and I know we talked about this last month, I believe it's September of this year, the elections for President Xi Jinping to become their permanent leader take place. You can't imagine that he wants to have a disenfranchised voter base as they head into that. So I think the alignment of a lot of these data points in conjunction with this announcement earlier this morning does really kind of sync up with that story of, it looks like they're going to try and reinvigorate their economy, which ultimately could mean support for commodity markets generally. That being said, we obviously talked about the fact that we're seeing slower growth within North America, slower growth within Europe. My personal opinion, again, take it for what it's worth. If I was a betting man, I think Europe is going to have a much tougher go of it than the United States and North America is in the coming, let's say, 6 to 12 months. And one of the main reasons why I have that opinion is shown right here in this chart. This is going all the way back to 2007. And what we're looking at here is electricity pricing for France and electricity pricing for Germany. Germany is going to be in the white line. France is going to be the blue line. But they're extremely highly correlated, and it's because they're ultimately running on similar energy infrastructure. What's made me most scary about this chart is the fact that sometimes power prices, electricity prices, they can spike up for a couple days. We've seen it here in North America when you have extreme tension to the grid. You can see prices go exponentially higher for just a couple days. We saw that, I think, maybe 2 or 3 summers ago here within North America. Power bills for a month go way to the moon for manufacturing centers. So my point is, spot power prices can be very, very volatile. The issue here is these aren't spot power prices. what we're looking at here is actually the 1 year forward base load power price. So for all intents and purposes, this is basically your ability to lock up power a year into the future. Because it's looking forward so far into the future, typically this market for the 1 year forward power price, normally it's much more stable. And you can see that, for 2007 all the way to 2021, I don't know, you maybe had a $30 or $40 range on those power prices. Well, in the last couple of months, we've seen prices jump by about 6 to 7 times their historical average. And why is that an issue? Well, if it's not glaringly obvious, everybody who makes anything has to use power to some capacity, whether it's turning the lights on. Even if you're a services organization, you're still turning the lights on, heating your home, cooling your home. That's requiring electricity. And I'm kind of calling it a wrecking ball. This poses a potential risk to, I would say, the manufacturing economy, or maybe the economy in total for Europe. And I don't want to be too hyperbolic here, but you look at that chart and that is an extreme move. That's a type of scenario where you're probably going to start to see, and I think we already are beginning to see it, power rationing and energy rationing within that country. So that could equate to shutdowns of things like aluminum production, magnesium production, things like that. Things we've seen before in recent months. And but I think the only saving grace really here is that many manufacturing companies oftentimes lock up long-term power contracts. So this may not affect everybody in the same way, but for those who don't have long-term fixed price agreements with their power companies, they're feeling the hurt right now. And I think this is going to be a very interesting, difficult scenario for probably all of our customers who have any kind of European exposure. The good news potentially for North America is, if in the event this persists, any manufacturing companies that are thinking about setting up shop, if they're trying to decide between North America or Europe, you would presume that they would lean towards North America right now, just based on the cost of doing business with regards to manufacturing. So on the metals overview side, this is going to be a little bit of an abridged version because we do have so much to talk about on the roundtable, but obviously we'll have Q&A if there are any questions on things we've discussed in the past that maybe you want to talk about again. But first, looking at carbon, this is a new chart. I don't think we've run through this exact scenario before, but what we're looking at here is the white line is going to be your current futures market. So these are the actual futures prices looking out by month into the future, basically into March of 2023. And you can see that there's an expectation that we'll see a bit of a decline and then start to level out somewhere in the mid 800s based on where futures are sitting today. That's kind of where they're pricing. That's where the expectation is. If we instead try and determine a fair value for steel prices by applying some kind of spread to scrap prices, because if you think about it, really the main cost of doing business for electric arc furnaces within North America is scrap. Obviously, there's an energy component, a labor component. But if we take let's say a round number of $300, slap that onto the busheling scrap futures market, you get what's shown in the yellow line. So I'll call that yellow line roughly to be fair value of steel prices. Basically the pricing under which an electric arc furnace would be comfortable-ish to sell steel. You can see there is generally a convergence between the two lines. So I would say we are heading towards fair value as we sit here today. The one caveat I will say to that, and again, this is pretty fresh data, is that the expectation for busheling scrap prices for the month of July are expected to reset down by up to $150, which that is a big move in scrap. And if that transpires, ultimately what that means is the potential for that yellow line, the yellow curve, to shift lower may be more possible, because if you think about it again, if scrap is dropping by $150, that means that an EAF's ability to make steel from scrap is going to get easier as well. So something we want to keep an eye on. It's definitely a very fluid situation there, but down is certainly the trend in the spot market. But I think we're going to begin as we roll into the later months of summer. I think we're going to see the pace of those declines really begin to wane, and maybe we perhaps see a little bit of a troughing effect. It's going to be a similar story within aluminum prices, which is, for now, the trend is lower. I mentioned the fact that the news this morning coming out of China did prop things up a little bit. We'll have to see if that becomes a more pronounced theme. But for now, prices have come off about 70 cents per pound on the London Metal Exchange. And again, all that's coming from the things we already talked about, which is growing recessionary fears within, I would say, North America and Europe, and perhaps emerging markets. And then a lockdown China. Those two factors combined created a pretty ugly situation for demand of base metals. And you can see that very pronounced here within this chart. This is a 5-year chart. One thing we have not discussed before is shown down on the bottom, and I apologize if it's a little difficult to see, but what we're looking at down at the bottom of this chart, and I'll show it for nickel and copper as well, this is called the relative strength index. And then, again, Nick likes charts. This is a chart or visual way to look at basically how bullish or bearish is the market. A lot of traders use this as kind of a contrarian indicator that if things are getting sold off extremely hard and on a relative strength index basis, per this chart, things get below 30 on an RSI, perhaps that means that things are getting a little oversold. To coin the Warren Buffett term, maybe there's blood in the streets, and that's the time to be bullish on a market. You can see that it really doesn't happen too often that aluminum prices drop so far so fast that you dip below that green line, which is a 30 of an RSI of 30. It happened back in the COVID lockdowns. It happened once, let's say about 6-7 months ago, when we started to see the new variants post Thanksgiving of 2021. But again, it doesn't happen too often, and we have recently seen the RSI dip below 30. So again, this is not investment advice. I'm not saying pile in and buy all the aluminum futures you can, but from a technical standpoint, it does look as though the market is pretty oversold as we sit here today. You can always go deeper into oversold territory, and when I show you the copper chart, you'll see that. And even if you look back to the COVID lockdowns back in 2020, we did go deeper into oversold territory. But this is just one potential indicator that one could use to kind of try to see where a trough may be in some of these markets.
Hey, Nick, real quick, is the energy crunch starting to hit aluminum here? Because I did notice that announcement recently, Century Aluminum closing.
Yeah, no, it's a great point, and I apologize for skipping over it. Yeah, what Mike's talking about is Century Aluminum probably 2-3 weeks ago, and I'll be honest, I'm a little surprised that it happened there of all places, because as we discussed a few slides ago, if we think we're having energy issues, well, they're probably 5 to 10 times worse over in Europe. So if it was going to start anywhere, I actually would have expected it to be over there first. But what transpired was Hawesville, which is one of the locations of Century Aluminum's smelting activity, they basically said because of high power prices, they can't continue to make aluminum profitably, and they were shutting down. I believe it was for a duration of at least 6 to 9 months. It may have been indefinite, but those are, coming back to that phrase I mentioned, which is energy is a wrecking ball. Those are the types of things that, unfortunately, we can hike interest rates as far as we want, but if power prices stay high just because of shortage situations, then you're going to start wrecking the supply side of the equation further. And yeah, those things are real risks. And again, I think here within North America, that is a potential. I know that Harbor Aluminum had mentioned New Madrid as being another potential entity who might have to have curtailments or shutdowns. But yeah, I mean, within Europe, if any of these producers have to go back to a power company and renegotiate their contracts, good luck, because they're not going to be able to sell aluminum at a profitable level that will allow them to make money if they have to reset their power prices in this market.
So just to confirm, are the energy prices being reflected in the price of aluminum now, or increases?
So I think I would say short answer is the spot prices of energy are not being reflected in aluminum. But the reality is a lot of these aluminum companies have long-term power contracts, so they aren't subject to the spot price in many instances. But no, I mean, if every producer was, let's say their power company said, we're not honoring these contracts and you have to buy off the spot market, absolutely, aluminum prices are not where they would be. You would probably have to see substantially higher aluminum in order to be able to make it profitably.
Makes sense. Okay.
Similarly, on the nickel side, we've talked about this for a while, but ever since that squeeze happened back in late February, early March of 2022, prices they actually went to $50 a pound. We've seen pretty erratic and ugly trading, but for the most part, we have reverted back to the pre-squeeze type price levels. Liquidity remains difficult to come by. A lot of traders have left. A number of traders have sued the London Metal Exchange for hundreds of millions of dollars. And it's still a pretty ugly situation. But the good news for our customers is that squeeze in terms of pricing means that, or I guess coming back down to the pre-squeeze levels means that surcharges should similarly reflect, I would say, somewhat significantly lower pricing on the commodity side, both from nickel prices, but also from chrome, which is going to reset lower for the following quarter, down by 36 cents. And then, as I mentioned earlier, scrap prices are coming down as well. So a lot of the commodity components, at least for now, within stainless are headed to the south side. And then lastly, I mentioned that idea where you can go into oversold territory and then continue going deeper into oversold territory. We certainly have seen that within the price of copper. And again, this is probably a breath of fresh air for a number of our customers who buy copper, because prices have drastically and quickly gotten cheaper. But again, when we look at the RSI, or the relative strength index down below, these are pretty intensely severe oversold conditions. And I checked yesterday, before today's 5% rally coming on the back of the Chinese news, these were even more oversold conditions than back in 2020 when the world went into lockdown. So again, I'm not saying step in and buy all the copper you can, but just from a technical chart kind of momentum side of things were pretty ugly within the copper market. And I would say that we're beginning to see that stabilize a little bit. I think China's for sure having a say in that, or they're having an element of impact on the copper market here.
Hey, Nick, a question from the avid fans here. Back to stainless. Is chromium a concern for stainless surcharges increases in the next month?
No, actually, so the opposite. As we sit here today, we now know that it'll take effect into August surcharges. The chrome resets going from $2.16 down to $1.80. So just that in a silo is expected to have an impact of about 6 to 7 cents to the downside on surcharges just from the chrome aspect. So I guess a little bit of good news there. So yes, there will be an impact, but it's going to be the downside, not up.